I was having lunch with a friend last year, someone I've known for 30 years, and he told me something that caught my attention. He said he just moved his entire retirement portfolio into bonds and cash. He was 62, planning to retire in a few years, and he was worried about market volatility. He figured he'd worked too hard and saved too long to risk losing it all in a crash. Better to play it safe, he said. Lock in what he had and call it a win. I understood his thinking. I've heard it hundreds of times from people his age, but I also knew he was making a mistake, possibly a serious one. Not because bonds and cash are bad, but because his strategy didn't match his reality. He was treating retirement like a finish line when it's actually more like the halfway point of a very long journey. And the decisions you make about that reality, especially once you hit 50 or beyond, can be the difference between running out of money at 75 and living comfortably into your 90s. What I want to talk about today isn't complicated, but it's something a lot of people get wrong. It's about how to think about risk as you get older, and specifically, how to avoid making your portfolio so conservative that you create a different kind of danger. This is educational information based on principles I've learned over many decades. It's not personal advice for your situation. Everyone's circumstances are unique, and you should absolutely work with a qualified financial professional before making any investment decisions. But I think understanding this principle can help you avoid a costly mistake. Here's the core issue. When most people think about investing in their 50s, 60s, and beyond, they focus almost entirely on the risk of losing money in the market. They imagine their portfolio dropping 30 or 40% and they panic. So they shift toward bonds, toward cash, toward anything that feels stable. And I get it. Stability feels good when you're close to needing that money. Nobody wants to see their life savings cut in half. But what they often miss is that playing it too safe creates its own risk. If you're 55 or 60 and you expect to live into your 80s or 90s, you've potentially got 30 or 35 years ahead of you. That's not a short time horizon. That's longer than most people's entire working careers. And over that kind of time frame, inflation becomes your enemy. It quietly erodes your purchasing power year after year. And if your investments aren't growing faster than inflation, you're getting poorer, even if your account balance looks stable. Let me put some numbers to this so you can see what I mean. Let's say you're 60 years old with $500,000 saved for retirement. You decide to be conservative, so you put it all in bonds yielding 3%. You think 3% is safe. I'll earn $15,000 a year. That plus Social Security should be enough. Sounds reasonable, right? But now let's factor in inflation. Let's say inflation averages 3% over the next 25 years. Not a crazy assumption. That's been roughly the historical average. What happens? Your bonds are earning 3%. Inflation is running at 3%. So your real return after inflation is zero. You're treading water. Meanwhile, the purchasing power of that $500,000 is being cut in half every 23 years or so at 3% inflation. By the time you're 85, your money buys what about $250,000 bought when you were 60. You haven't lost money in nominal terms, but you've lost enormous amounts in real terms. Now, compare that to a different approach. Same person, same 500,000, but instead of going all bonds, they keep 60% in stocks and 40% in bonds. Stocks historically have returned somewhere around 9 to 10% annually over long periods, though there's no guarantee they'll continue to do so. Let's be conservative and say they earn 7%. Bonds earn 3%. The blended portfolio earns about 5.4%. After 25 years, that portfolio is worth about $1.9 million. Even after accounting for 3% inflation, the real value is about $900,000 in today's dollars. That's the difference between maintaining your purchasing power and seeing it cut in half. Same person, same starting amount, completely different outcome based solely on asset allocation. Now, I can already hear the objection. What about the risk? What if there's a market crash in year 2 or year 5? What if I need the money and stocks are down 30%? These are legitimate concerns, and this is where the strategy matters. You don't just blindly put 60% in stocks and hope for the best. You need structure. The approach that makes sense for a lot of people in this age range is to think about your money in buckets. You've got your short-term bucket, which is money you'll need in the next 3 to 5 years. That should absolutely be in stable assets. Cash, short-term bonds, CDs, things where you know the money will be there when you need it. This is your buffer, your protection against being forced to sell stocks at a bad time. Then you've got your long-term bucket, which is money you won't need for 5, 10, 15, 20 years. That money can be invested for growth because you have time to ride out market volatility. If there's a crash, you don't have to sell. You can wait for the recovery. And historically, the market has always recovered from crashes, though past performance doesn't guarantee future results. I knew a woman who implemented this strategy beautifully. She retired at 63 with about $800,000. She calculated that she'd need about $40,000 a year from her portfolio to supplement Social Security. She took 5 years worth of expenses, $200,000, and put it in a ladder of CDs and short-term bonds. Money she knew would be there, guaranteed, no matter what the market did. The remaining $600,000 she kept in a diversified stock portfolio. What this did was remove the emotional pressure. When the market dropped, which it inevitably did several times over her retirement, she didn't care. She had 5 years of expenses locked in. She could afford to wait, and when the market recovered, which it also inevitably did, her long-term bucket grew. Every few years, she'd refill her short-term bucket from her long-term bucket, locking in gains during good years. It worked beautifully. By the time she was 80, her portfolio was worth more than when she retired, even after taking distributions for 17 years. That's the kind of strategy that makes sense for people over 50. Not abandoning stocks entirely out of fear, but structuring things so you can stay invested for growth without being forced to sell at the wrong time. You're managing both risks, the risk of market volatility and the risk of inflation. You're not ignoring either one. Now, let me address something else that comes up a lot with people in this age group. There's this idea that you should reduce your stock allocation every year as you get older. Some people follow a rule like your age in bonds. So if you're 60, 60% bonds, 40% stocks. If you're 70, 70% bonds, 30% stocks, and so on. I think that's too simplistic. It doesn't account for your specific situation, your income needs, your other resources, your health, your goals. Maybe you've got a pension that covers most of your expenses, so you don't need much from your portfolio. In that case, you can afford to be more aggressive because you're not reliant on the portfolio for income. Or maybe you don't have a pension and you need significant withdrawals every year. Then you need to be more conservative because you can't afford big drawdowns. The point is, there's no one-size-fits-all formula. You've got to think about your actual circumstances and design a strategy that works for you. But whatever you decide, I'd be very cautious about going too conservative too early. 50 is young. Even 60 or 65 is relatively young when you consider how long people live now. You've potentially got 30 or 35 years of retirement ahead of you. That's a long time to try to live on a portfolio that's not growing in real terms. I also want to talk about Social Security timing because it ties into this. A lot of people claim Social Security as soon as they're eligible at 62. They figure they want the money now, or they're worried the system might go bankrupt, or they just don't want to wait. But claiming early means you get a permanently reduced benefit. If you wait until your full retirement age, which is around 66 or 67, depending on when you were born, you get your full benefit. If you wait until 70, you get an even bigger benefit, about 8% more for every year you delay past full retirement age. For a lot of people, especially those who are healthy and expect to live a long time, delaying Social Security is one of the best financial moves they can make. It's essentially a guaranteed increase in lifetime income, and it gives you more flexibility with your portfolio. If you can delay claiming by working a few extra years or by drawing on your portfolio initially, you end up with more guaranteed income for life, which means you can afford to take more risk with your investments. I knew a couple who did this calculation and decided to delay Social Security until 70 for both of them. They used portfolio withdrawals to cover expenses from 65 to 70, which reduced their portfolio a bit in those years. But once they hit 70 and started claiming their Social Security income was high enough that they barely needed to touch their portfolio. That portfolio then continued to grow through their 70s and 80s, providing a cushion for later years when expenses might increase due to healthcare needs. This is strategic thinking. This is looking at the whole picture, not just one piece. Too many people make isolated decisions without considering how everything fits together. They claim Social Security early without thinking about how that affects their portfolio strategy. They shift entirely to bonds without thinking about inflation risk. They focus so much on avoiding market losses that they guarantee losses to inflation. Let me tell you about another aspect of this that I think is critical. A lot of people in their 50s and 60s underestimate how much money they're going to need. They do some rough math, figure they can live on 70 or 80% of their pre-retirement income and call it good. But they forget about healthcare costs, which tend to increase as you age. They forget about the possibility of long-term care, which can be devastatingly expensive. They forget that they might want to travel or pursue hobbies or help their kids or grandkids financially. What often happens is people retire with what seems like enough money. They stick to a conservative portfolio, and 15 or 20 years later, they realize they're in trouble. Their expenses were higher than they expected. Their portfolio didn't grow enough to keep pace. And now they're either cutting back significantly or running out of money. That's a terrible position to be in at 80 or 85 years old. The way to avoid that is to be realistic about your expenses and to make sure your portfolio has the potential to grow over time. Yes, you need stability for near-term expenses, but you also need growth for long-term sustainability. Finding that balance is the critical skill. Now, I want to address something that might seem contradictory. I'm talking about the importance of staying invested in stocks, but I've also always emphasized the importance of not losing money. So which is it? Are stocks risky or not? The answer is that it depends on your time horizon. Over short periods, stocks are definitely risky. The market can drop 20, 30, 40% or more in a year. If you need that money in the short term, that's a problem. But over long periods, stocks have historically been the best performing asset class. Yes, there are bad years, but there are also good years. And the good years have more than made up for the bad ones. Over 10, 20, 30 years, stocks have outperformed bonds and cash by significant margins. So the risk isn't really in owning stocks. The risk is in needing to sell them at the wrong time. That's why the bucket strategy makes so much sense. You eliminate the risk of forced selling by having stable assets to cover near-term needs, and you capture the growth potential of stocks by keeping a portion invested for the long term. I've been investing for more than 70 years now. I've seen every kind of market imaginable. And one thing I can tell you with certainty is that betting against the American economy over long periods has been a mistake. Businesses adapt, innovate, grow, the economy expands, stock prices follow. There are rough patches, sometimes prolonged ones, but the overall trajectory has been up. That doesn't mean you should be reckless. Doesn't mean you should put all your money in speculative stocks or chase performance or ignore risk. But it does mean you should think carefully before abandoning stocks entirely just because you're getting older. You're not just investing for the next year or two. You're investing for the rest of your life, which could be another 3 decades. Let me also mention something about volatility tolerance. Some people genuinely can't handle seeing their portfolio drop even temporarily. They check their account every day. They worry constantly. They can't sleep when the market is down. For those people, a more conservative allocation might be appropriate, even if it means accepting inflation risk. Because if you're going to panic and sell at the bottom anyway, you might as well not be heavily invested in stocks to begin with. But I'd encourage you to think about whether your volatility intolerance is based on a real assessment of your situation or just on emotional reactions that can be managed. If you've got a proper bucket strategy, if you've got years of expenses and stable assets, then short-term market drops shouldn't actually affect you. You don't need to sell. You can wait it out. The volatility is just noise, not a real threat to your financial security. A lot of times, volatility intolerance comes from not understanding what you own or not having a plan. If you know exactly how much you have in stocks versus bonds, if you know why you own each piece, if you've got a clear plan for how you'll fund expenses in different market environments, you're much less likely to panic. It's the uncertainty and lack of structure that creates anxiety. So part of preparing for retirement is getting your mindset right. Understanding that markets go up and down, that volatility is normal, that short-term losses are not the same as permanent losses. Building that mental framework so you can stay disciplined when things get uncomfortable. I'll give you one more example. I knew a man who retired at 60 with about $1 million. He was nervous about the market, so he put 80% in bonds and 20% in stocks. Very conservative. Over the next 15 years, his bonds earned around 3% annually, His stocks earned around 8%, and his blended return was about 4%. Sounds decent, right? But here's the problem. He was withdrawing about $45,000 a year for expenses. At a 4% return on a declining balance, his portfolio couldn't keep up. By 75, he was down to about $450,000. At that rate, he'd run out of money in his mid-80s. And he was starting to realize that he might have another 15 or 20 years to live. He'd been too conservative, and it was going to cost him. He ended up having to go back to work part-time in his mid-70s, not because he wanted to, but because he needed the income. If he'd had a more balanced portfolio from the start, maybe 60% stocks and 40% bonds, his returns would have been higher, his portfolio would have held up better, and he wouldn't have been forced back into the workforce. That's the risk of being too conservative. It doesn't feel risky because you're not experiencing volatility, but you're slowly, steadily depleting your resources. And by the time you realize it, you've often lost years of potential growth that you can't get back. So here's what I'd say to anyone over 50 thinking about their investment strategy. Don't make the mistake of thinking that retirement is a finish line where you suddenly need to be ultra conservative. Think of it as a long phase of life where you still need your money to work for you. Structure your portfolio so you have stability for near-term needs and growth for long-term needs. Consider delaying Social Security to maximize your guaranteed income. Be realistic about your expenses and your time horizon. And most importantly, don't let fear of market volatility push you into a strategy that exposes you to the even greater risk of running out of money. The goal isn't to avoid all risk. The goal is to manage risk appropriately given your situation. For most people over 50, that means accepting some market volatility in exchange for growth potential. It means staying invested in stocks even as you get older, but doing so in a structured, thoughtful way that protects you from forced selling at bad times. This is how you give yourself the best chance of making your money last for a retirement that could easily be 30 or 35 years. Not by playing it safe with bonds and cash, but by maintaining a balanced approach that addresses both the risk of market losses and the risk of inflation. Both risks are real, both need to be managed, and finding that balance is the critical investment tip that can make all the difference in whether your retirement is comfortable or financially stressful.